Welcome, everyone, to another edition of the Tony Sirianni podcast. I'm thrilled to have my friend Grier Eliasek with us. He's the president of Prospect Capital. Thanks for being here. Appreciate it.
It's great to be on, Tony. Thank you for welcoming me.
Well, this is a really good time, to have you on or talk about, something that's in the news, quite a bit right now is private credit, and that's what you do and have done successfully for 20 plus years or whatever it is. Um, well, let's talk a little bit about what's going on in the news. And I don't pretend to know everything about this, but from your where you're sitting, your point of view, is this kind of a systemic issue with the asset class, or is this, something else, or, how should we be looking at it?
Sure. Well, Tony, it shouldn't be a surprise that private credit is a significant item of discussion given how much growth has happened. I think something like $2 trillion has been raised for private credit over the last 5 years. So, of course, it's natural there'll be a significant focus on private credit. There's no systemic risk related to private credit with the overall economy. Look at leverage. Banks are levered 10 to 1. Back in the GFC era, they were levered more like 30 to 1. And that's just very different. Most private credit funds are levered, 1 to 1 or less than that by comparison. Our leverage for our flagship is something like 0.4 to 1 debt to equity. So that's on the systemic side. But there are some watch outs that are important to look at, most notably related to liquidity for products that are purchased by investors. There are trade-offs involved. You buy something that's non-traded, and you enjoy less volatility than buying something that's traded and liquid, and you can buy and sell it like a stock, or it is a stock on the open market, but that value can fluctuate more. Non-traded, less volatile, however, it's more subject to potential gating when it comes to redemptions.
I mean, but most people, when they get into these things, I mean, they know this going into it that there's going to be less liquidity. I mean, that's why you have sort of this contraindicated, product, right, in your portfolio because it's not like everything else.
Well, they know it, perhaps. Maybe it was focused on, maybe not. Uh, but like a lot of things in life, maybe it's discounted until
Mhm.
your priorities shift,
Yeah.
or you have certain concerns that cause things like reading headlines that are sort of clickbaitish, designed to increase agita and concerns that can cause people to redeem, even if there's not necessarily a reason for it. I mean, it's not as if defaults have spiked significantly. Yes, there are macro concerns. There's inflation ticking up and crude oil ticking up, but we're not in the middle of a recession. This is not
Oh.
2007. And so a lot of this is a little bit of, sort of self-created echo chamber stuff of what's
So,
happening.
yeah, I mean, it's kind of a scary tell in general for the industry, all for everything, because there seems to be a lot of that. We talk about AI being, sort of, something that's going to come for everybody's job, but, human emotion is part of the landscape of the marketplace, and I'm not sure AI can figure that part out. There is one thing, speaking of technology and AI, that you and I have talked a little bit about, and that's part of this sort of what's going around and what's concerning people is AI in the private credit space and, exposure to software companies, meaning that software companies are, going to lose value because of AI and the way guys have. I know you kind of have a different view at your fund about it, but talk a little bit about that so we all get our arms around it.
Sure. Well, everyone's looking at artificial intelligence and just automation in general and trying to assess where is it a friend versus where is it a foe.
Yeah.
From an investment point of view, the potential foe aspect relates to making investments in software companies, especially enterprise software companies, that might, at a minimum, see their rates of growth decline and more significantly are at threat to their fundamental business model. So that is a legitimate concern. Of course, if someone's worried about private credit, where the average exposure is, say, 23%, for software, for private equity, it's well over 40%. You don't
Wow.
hear
I didn't
concerns
know that.
about private equity because most private equity funds are held by institutions. They're not held in registered products where you can see net asset values and redemptions and flows in a more transparent basis. But the first pain is definitely with private equity. Our view of Prospect and our software exposure is 3%. Is from a private credit standpoint, we'd like to use AI and automation to help our companies, but we're very wary about that in investing, especially making a loan where your upside is generally limited. You're just looking at downside, and heavy technology companies that can change rapidly are a risk, right? So you don't want to see rapid change occurring. We like these halo companies, hard asset, low obsolescence, or at least LO, low obsolescence type of companies. For example, we have a real estate credit business that lends money to multifamily apartments. AI is not going to reduce the need for folks to have a place to live, right? That's not going away. But these software companies were really levered to perfection, and in the real world, things are messier and other than perfect, right? So when AI comes along and reduces the rate of growth, it creates concerns about potential defaults. But again, we're only 3% software mix, so we sleep pretty well at night, and we utilize AI to make our companies more effective. For example, we have a company called Town and Country that is using AI for inventory planning and for product development. You don't need as many people to develop products. You can, generate mock-ups and presentations and
Yeah.
prototypes and that sort of thing much faster than in the past. Call centers, another area. We have a company called Interdent, and they're using AI to help automate with scripts and agents and the like. You just don't need as many human rote processing power as before. So that's the friend aspect
Yeah, so
of AI.
a way to get exposure to AI, but without having to have that risk of the software company becoming obsolete somehow. By the way, all this sunlight, this is God shining down on me and telling me I'm his favorite. I'm going to do that for us just to try to this. Oh, there we go. Okay, a little bit better. Sorry about that, Greer. Um, I think that 3% versus 23% is a big deal, right? And that should make people feel good. But you brought up a couple points there, which is that the company, the Halo stuff, and the companies that you look at, those guys who are exposed to 23%, and you and I have talked about this, are all chasing those same small number of companies, 10,000 companies, right? That are the upper end of the market that you're going to invest, the private credit guys are investing in. Whereas your ponds, your world is a little deeper, your ocean's deeper. You got 220,000 something companies. That this seems like common sense to me, but these guys are all chasing the same dollar, and we see it all the time. You see it in the stock, all markets kind of react like that. The top seven, the Magnificent Seven, everybody kind of chases the same dollar.
Right. I think the theme here, Tony, is small is beautiful.
Yeah.
And so there are, and you started to allude to some of that data. There are 230,000 US companies in the middle market. That's between 5 and 150 million of annual profit. Those trillions of dollars that we discussed have been raised are really focused on the companies between 50 and 150 million of annual profit. There's only 10,000 of those companies in the United States, which is not a lot for all
No.
that capital to be focused on. That leaves 220,000 companies with a size of 5 to 50 million of annual profit. These are still robustly profitable companies, just a little bit smaller, maybe more dominant in a particular industry niche. And it's not that there's no competition in that segment, there's just less competition. And like a lot of things in life, it's a return on effort world, right? So if
Yeah.
you have enough experienced people, we have 150 people We source 3,000 deals per annum. It's a look under rocks, needle in the haystack type business.
Yeah.
We're going to close 0.5% of those in a good year. That's what you need to do to go after these so-called lower middle market of smaller companies. What do you get in exchange for that lessened competition? You get lower risk and greater reward.
Yeah.
It's
Yeah.
huge payoff from it. So lower risk, lower leverage, higher quality of cash flows, fewer so-called add backs, better documentation, less lender on lender violence like what you see with
Right.
larger situations. And then what do you get for a reward? You get a higher lending spread, you get a higher floor. That's particularly important if the economy goes through a tougher time and the Fed does end up cutting more rapidly. Right now, it seems there's inflation is dominating, but that could change. And having higher floors is important. And then we
And
like to have a little bit of equity linked paper for some upside after we've covered our base
yeah.
of principal protection and income. So all those things are possible at the lower end of the market, really unavailable at the higher end of the market. Uh, Lower risk, higher rewards, and that's why we like the smaller deals.
And without, as I mean, there, as you said, there's competition, but without the same type of competition, when you get to these guys, you can dictate terms a lot more than you can at the upper end. Correct? I mean,
That's right.
the
That's right.
covenants, whatever.
Yes, there's and the counterparties we're dealing with are a little bit different. At the higher end of the market, those 10,000 companies we talked about, very small, finite universe,
Yeah.
it's essentially all owned by private equity. Larger, very sophisticated owners who are very good at running eBay-like auctions to play off lenders against one another and grind them down to a race to the bottom on terms. That's been occurring for years with really no end in sight, even in the current environment. At the smaller end of the market, we have a broader array of ownership types that we deal with. We're dealing with sort of smaller funded private equity firms that aren't as overbanked. We're dealing with independent sponsors.
And
We really
and
like those.
also founders, right? I mean, you're dealing with
Yes,
founders, and if you're dealing with a founder, oftentimes their priorities are very different. Their priorities involve, family situations, like, help me with this. This is my problem, right? I have four
absolutely.
kids, or I have this or that, and you've got to sort of settle at that. But in a lot of ways, it seems more natural.
Absolutely. A good example of that would be Taos Footwear
Mm.
in our portfolio. Taos, similar to the famous New Mexico mountain and ski town. This is a women's footwear provider. It's been in business for 20 years, robustly profitable business. Not a startup, not a technology business, but benefiting from being a significant player selling directly to consumers online as well as wholesale. Founder owned, CEO run company who wanted to unlock partial liquidity, but continue to build the business and also tap into value add from an institutional player like Prospect, who has multiple portfolio companies, and this founder CEO can learn from those companies. That's a wonderful opportunity for your advisor
Absolutely.
constituent base, Tony. When you think about it, they're managing certain assets for entrepreneur, founder, family owned and run companies, but that obviously doesn't typically include the business where a huge
Yeah,
amount of value
I
resides.
mean, yeah, the client you just described, it would be like typically the best client in an advisor's, portfolio. So in their book, they might have one or two, or, if they're lucky, three or four of these type of clients that own businesses. The challenge for advisors, Greer, is that, it's like like the story in Hollywood when you have an agent and he takes you through a bunch of commercials, and then you get a movie and you dump the agent, so this is the kind of thing where they can take them through and they help them. They're helping with all their personal stuff. And then when they sell the business and there's a big liquidity event, whoever did the sale of it takes the client away, and they don't
Mm.
ever get to see it. So, but in this scenario, that's not the case, right? I mean, this is a little more keep everybody involved. In other words,
Right.
you also want the CEO, like a lot of these PE firms, they know better. They're going to help run this company. I mean, you want them to keep doing what they're doing. They know how to run the company. You don't, so keep doing it.
Absolutely. So in the case of Taos Footwear, and by the way, that's a deal that took over a year to close,
Yeah,
showing again the return on effort of these smaller companies. It's not easy business. It's a lot of hard work to build those relationships, diligence these companies, et cetera. But yes, from an advisor point of view, being value add is important, right? You don't want to
yeah,
be commoditized in any market, including as a registered investment advisor. So the more that you can add value to a client with tax planning, and that's something, by the way, that we can assist with tools at Prospect. We have a fairly robust tax department, expertise in family limited partnerships and grantor retained annuity trusts and a whole host of different tools. But if there's value add there and other forms of advice for clients, I always think there'd be a more embedded relationship such that when a liquidity event occurs, that client isn't whisked away, but rather stays with the advisor, especially the advisor help to facilitate some of that liquidity by maybe making an introduction to a firm like Prospect Capital. We're very interested in that two-way street relationship with the advisor community, not just showing investment solutions for our various product offerings, but also sourcing deals. Because when we're sourcing over 3,000 deals per annum and closing far less than 1% of those, we want the wide end of the funnel to be feeding as many attractive deals as possible. So it's a two-way street as we see
yeah.
it.
And certainly from an advisor's perspective, I mean, making clients sticky by by being the guy who brings the capital to the table and the expertise maybe to, help the family long term. That's a great combo. Can't do it. So you mentioned briefly before about how to sort of produce some equity-like returns or get some equity-type balance using warrants. Will you go through that a little bit more detail so we can get that organized?
Absolutely. So, our main objective is to protect capital, and you're making a senior secured loan, first lien, and then produced income from
Yeah,
that. But if you're in the business of solely making loans over and over and over again, X% of the time, which is very small for us, but it still occurs from time to time. No one's perfect. You're not going to receive your full contract of interest and principal. So to counteract that, and hopefully more than counteract that, to produce net greater returns, we like to have some upside in these deals, and we find that creates more alignment that business owners like.
yeah,
So
sure.
in conjunction with making a loan, we'll often get warrants that give us a percentage upside in the company, or sometimes it's structured as convertible debt where we're making an additional investment that has downside protection, but again, also benefits from upside. So we think that's important. It also makes us even more invested in the success of these businesses to produce strong results. And it was very popular in the 80s and 90s
Yeah,
to talk about the Japanese kairetsu effect. Remember, that was a big
yeah.
topic where you have a portfolio of businesses that can learn from one another and even do business with one another. We try to bring that alive in our portfolio every day by having CEO to CEO introductions and other members of the management team to learn from one another at a minimum, but also to do business. We have, for
Right.
example, a personal care products company which is going to strike a logistics deal with another business in our portfolio for mutual benefit and shared savings. So we like to see that quite a bit, and that's the value out of bringing a portfolio approach to these deals.
And then also the public markets versus private markets. Some of these things are publicly traded, some are privately traded. Do you want to just go through just quickly because we're actually running out of time, maybe the differences between the two and where the values are in your point of
Absolutely. So And we believe in offering choice and then let folks choose what's comfortable for them. So, we have our flagship permanent capital business prospect capital corporation that's publicly traded, has, second by second liquidity. We also
Yeah.
have a preferred program for that, which is pretty interesting because it offers the same benefits of interval funds with mandatory liquidity, but with no change in net asset value. It's a zero
Yeah.
volatility,
Right. Okay.
stable NAV proposition. And then on the non-traded side of things, we have a real estate credit offering, which is very attractive from an economic standpoint. Early on, focused on lending money to multifamily, and then we have an interval fund as well that's focused on structured credit. And what's very important is to make sure when you're offering mandatory liquidity that can't be gated, that you have enough liquidity in the underlying assets. That's
Yeah.
something that's an issue for some interval funds out there that we've thought very carefully
Seeing
about
that.
before bringing these to market.
Yeah. Yeah. All right. Great. Well, look, that's look, believe it or not, I mean, we're at this 20-minute mark. Is there anything that I didn't ask you about that you wanted to say, or even I guess as a last, I'll ask one more question, which would be, you're the, you guys seem to be well positioned, but the industry itself, like you said, there's a sort of a lot of talk around it. Where do you see this in 3 to 5 years? Where do you see the private credit markets in 3 to 5 years?
Well, I think the private credit market is going to be larger than it is today. It's not retrenching. Maybe naturally the rate of growth is going to slow. I mean, you don't have that much explosive growth that goes on
Yeah,
forever
forever.
and ever. Trees don't grow to the sky, so to speak. But I think there be real differentiation will emerge after a while. Maybe some disappointment from folks about the liquidity wasn't quite what they thought, or the
Yeah.
returns perhaps not quite what they thought at the upper end of the market, and maybe looking more broadly at other strategies and differentiating what folks are doing. I think there's going to be more of a finer segmentation to occur over the next 3 to 5 years. But fundamentally, banks have gotten out of the business of cash flow lending, which is what the private credit market has gotten into, and we don't see regulation unwinding that
Yeah.
for banks that really are relegated to lending against hard asset collateral, and that's it.
Yeah. So good opportunity in the future anyway. Well, look, thank you for being here. We should do this again, maybe just check in on the markets, see how they're doing. But it's always interesting to talk to you, Greer. Thanks for being part of the show.
Absolutely. Thank you, Tony, and thank you everyone for listening. Really appreciate it.